Investments. They're crucial for long-term financial stability. Unfortunately, they do come with considerable risks. However, there is one form of investment that has lower volatility and offers steady income. No, we are not talking about fixed deposits. In fact, it offers potentially better returns compared to fixed deposits. Best part is, it requires minimal monitoring. Introducing direct bond investment, available in Ringgit Malaysia and foreign currencies. So what is direct bond investment? It begins with the primary bond market through what's known as an initial public offering, or IPO for short. During the IPO, the issuing body will sell IOU contracts on a first-come, first-served basis with guaranteed coupons. They do this to borrow money from the public. Keep in mind that at this stage, the bonds are sold at a price set by the distributor, also known as the customer price. When the IPO is over, interested parties will only be able to purchase bonds in what's known as the secondary market. This is the period in which the price of the bonds may fluctuate from the initial price, depending on market conditions, as the prices are set by buyers and sellers, not the issuing body. When a new purchaser buys a bond at a price higher than its initial price, it is called a premium. Naturally, this would reduce the buyer's rate of returns. However, when a new purchaser buys a bond at a price lower than its initial price, it's called a discount. And of course, this would mean that the purchaser stands to gain a better rate of returns. Now, the tenure of such an investment depends on when the bond matures. Some last for 2 years before maturing. Others may even last up to 10 years. And then there are the bonds that have no predetermined maturity dates, known as perpetual bonds. Investors get coupons for as long as the bonds run. What is the difference between stocks and bonds? While they are both investment vehicles, they have key differences. Stock is an instrument carrying ownership interest. When you buy stock, you own a part of the company that sells you the stock. On the other hand, a bond is a debt instrument that promises to pay back the principal with coupons. In simpler terms, it means you are lending money to the company or government, money that needs to be repaid to you with returns. How does one earn from stocks or bonds? Stocks do not have predetermined returns. However, they may distribute dividends to their stockholders, which is dependent on the policy and performance of the company. On the other hand, bonds have predetermined returns. Buyers of bonds get an income in the form of contracted coupons. What special benefits can one get from stocks or bonds? Another difference is that stockholders have voting rights in the company, whereas bondholders have preferential treatment upon maturity. How long does one need to hold on for stocks or bonds? Stocks neither have fixed maturity dates nor holding period requirements. Stockholders may buy or sell them at any time they wish. Bonds, however, have fixed, conditional, or perpetual tenures spelt out during their point of sales. That being said, investors still have the option to sell the bonds prematurely in the secondary market, but investors are advised to hold on to the bonds until maturity. How liquid are stocks or bonds? Stocks are also more liquid due to its smaller minimum purchase amount. In comparison, bonds are not as liquid and may require a longer time to find a buyer, depending on supply and demand of the particular bond paper. Now that you know the difference, here are 6 interesting facts about bonds. Firstly, bonds are commonly rated by credit rating agencies. In Malaysia, RAM and MARC provide ratings to local corporations, while foreign entities are usually rated by Standards & Poor, Fitch and Moody's. Secondly, there are unrated bonds as well. Usually such bonds have higher coupon rates that commensurate with the uncertainties of the bond papers. Don't worry though, if it is unrated, there's still the issuer's obligation. So long as the company is fundamentally strong, investors can sit back, relax, and enjoy the coupons on a semi-annual basis. Thirdly, there's no renewal hassle. Coupons are contracted for a certain amount of years based on the predetermined coupon rate. Fourthly, some bonds are pledged by securities. They can be collateralized with land, property, or high-value projects. This would provide some extra level of comfort in the event of a default. Fifthly, bonds are more secure with lower volatility. Their prices have less volatility relative to stocks. So long as the company's financial standing is intact, the price movements of bonds are fairly limited. Lastly, some bonds have early termination features. These are known as callable features, where the issuers have the flexibility to return back the principal and final coupons on a stipulated earlier date. Here's a quick recap on the benefits of direct bond. Like all investments, returns are associated with risks. Please be sure to read and understand the offering documents carefully before making an investment decision. For more information, please contact your relationship manager.